Thanks so much. Oh, right. Everyone, we're recording, just so you know. And thank you so much to Greenwich Library for these programs. I mean, Greenwich Library does a great job, whether it's careers, entrepreneurship, investing, anything business related. It's really extraordinary what the library does for the community. So thank you. And welcome everybody to the Investing Discussion Group. This is actually season 3 of the Investing Discussion Group. And this season is based on requests from people in the group that we cover certain topics. We had reached out, Young Wong, who helps run this group. She and I reached out to the various people who had participated, and the topics that seem to bubble up, people are always interested in taxes, obviously, legally saving on taxes. People were interested in asset allocation, how to tackle college now that a diploma at a private university could be almost $400,000 in a few years. So that's pretty scary. People were very interested in the economy. So these were all these topics we were asked to tackle. We've tackled a lot of them. And just so you know, for this season and the past seasons, all these videos live on the library's YouTube channel. So if you go to YouTube and you enter Greenwich Library in the search bar, you'll see the sort of white and green logo with the open book, with the outline of the tree. And if you click on that, it goes to the Greenwich Library channel, and then you can look for these videos. They're pretty easy to find under the video section. And we've had some really, really popular ones, like covering Morgan Housel's book, The Psychology of Money. It's very unusual for a personal finance book to sell 2 million plus copies. So that's quite a feat. Morgan Housel totally deserves the fame that he's receiving, and his book was brilliant. So people really enjoyed discussing the psychology of money and what was the sort of message of the book, what were the different chapters about. The Power of Zero is another book that's based on taxes and how can you really lower your tax bill. So that was very powerful. Again, asset allocation we've done. So there are a lot of great videos from the Investing Discussion Group that live on the library's YouTube channel. And like hopefully you heard at the beginning of this, we're also recording this one. So this will also be there. Okay, so today we are doing Bond Bombshell, a little clickbait title for you, but making sure that I'm a huge fan of bonds. We're not trying to take anything away from what bonds can do for you, but it's really important to understand some of the risks and the downside of bonds. There's a myth, persistent myth, that bonds are safe. Some bonds are safe, some bonds are very risky. So we're going to tackle that. And then planning ahead, we meet once a month. And then next month in March, we're talking about startups from the view of investing in startups. So there are a lot of angel investor groups in Connecticut that really get into that. You can also just from the comfort of your home go online and invest in startups. And this is kind of a new thing that people aren't necessarily aware of because security regulation changed. And you can actually look at different companies that kind of are vying for your money and telling their story, and you can get in for a very low cost, or even starting your own business. So we're really going to cover startups from a lot of different angles about, how can that be a good investment for you? Okay, and then quick disclaimer, we really get into talking about specific investments, but we want to point out that this is all just education. None of this is investment advice. So none of the investments that we mention are specifically discouraged or recommended. So for you personally, if you are going to make an investing decision, please consult a professional, like a tax expert, financial advisor who's aware of your unique situation. And also, please feel free to participate. I mean, you can unmute and ask a question. You can put a question in the chat. We're going to try to keep checking the chat just to make sure that we don't miss anything, but this is absolutely meant to be a discussion group. Okay, so our topic today, Bond Bombshell. Now, unless you were living under a rock in 2022, you are probably aware that one of the reasons we're saying it's a bond bombshell and we're sort of torpedoing this myth that bonds are safe is that bonds were really rocked in 2022. So this idea that bonds don't lose money or bonds are always safe, that was very, very challenged in 2022. It was the worst year for bonds ever. Certain bonds, the bonds that have the longer terms, the greater, the long, maturity dates that are way out there, like 20 years and 30 years, got really rocked. And we'll talk about that and why. So obviously, if you're going to invest in something because you think it's safe, it's really important to understand, to be able to understand where the risks lie, because some people got a very, very rude awakening. 2022 was a terrible year. Unfortunately, a real double whammy, because stocks were also down significantly. So bonds were not a safe haven, which is really, like, for a lot of people, they think of bonds as almost like the ballast of the ship. You're not going to make a lot of money, but it's going to steady the ship when stocks are going crazy and losing value. And that absolutely didn't happen. So that's why we're here tonight, to not to disparage bonds, but to really help you understand what would make bonds lose money. And you're welcome to take those risks if you want, if you understand them. But you should really be able to be a very educated consumer of bonds. Okay, so we're debunking the myth that bonds are safe. And again, I really like bonds. I own bonds. This is not to diss bonds in general. It's just to educate you so that you know how to shop for the bonds that would be suitable for your needs and your risk tolerance. So when you look at bonds, there are several risks to consider. The 2022, what happened in 2022 and why did bonds just crater? That was absolutely interest rate risk, right? So which really educated investors should have been prepared for. If they understood how bonds work, then they should have been realizing this tremendous risk was like already in the air, on the horizon, right? Because interest rates were incredibly low. Bonds had very low yields. So if you understand how bonds operate and you understand that bond prices fall when interest rates rise, then holding a bond that's like a 20-year bond that's only paying 2%, like that would be very unsettling. If you truly understand how bonds work, you wouldn't lock yourself into that kind of a rate. So it's really important to understand interest rate risk, especially if you're buying bonds that have a long term. And we're going to talk about what I mean by term and maturity and duration. And a lot of people use duration interchangeably with term, but it's actually very different. But we'll talk about that. We'll get down to interest rate risk. There's also credit worthiness risk, right? So a bond is a loan. So, who are you loaning? Like to what entity would you loan money? And if you could think of it as even loaning money, like how would you even decide to loan money to a person, right? Like, are they trustworthy? Will they pay you back? Do they have the means to pay you back? So, it's the same thing when you're loaning to maybe it's kind of shady government. There are a few governments out there outside the US that, are not ideal. You've certainly heard of bond defaults in South America and things like that. Don't want to name any particular country right now, but, there are countries out there that are not a good credit risk. There are corporations out there that are not a good credit risk. There are entities that are not a good credit risk. I mean, it's amazing how many entities actually issue bonds. I mean, you could probably check with the college you graduated from. They might have issued a bond. I mean, the bond issuance is very, very common. It's a very common way to raise money. So not all bond issuers are created equal. So we'll talk about that. And there's an entire system around rating bonds, and it's very easy to access. It's very easy to access at the library, believe it or not. So we'll talk about that. And then there's fund risk. So a lot of people, their first introduction to buying bonds is they get a 401k menu, and they're not going out and buying an individual bond, which has become very easy to do, by the way, but they're not doing that. They're getting their 401k menu, and maybe they're selecting a bond fund. Well, bond funds come with their own risk, because you lose control of when the bonds in the fund are purchased and sold. And normally that's not a problem. Bonds are run by very reputable managers, but we're going to talk about when it is a problem. Then there's something called call risk, and I'll just leave you all in suspense. I'll define it later, but that's another risk. And then, of course, we're going to end on like the really good news, because there's so many excellent things about bonds. Bonds should absolutely be a part of most people's portfolios, especially as you get older. So we're definitely going to end on the good note, but we're going to educate you on the things that could go wrong. Okay. And I, don't know anyone's skill level out there, but just, to be on the safe side, let's be very clear what we're talking about when we're talking about bonds. So a bond is a debt security. It's like an IOU, right? Like if you're purchasing a bond, you're actually loaning money to some entity. So some issuer, and like I said, there are all different kinds of issuers. Like Babson College issued a bond. Babson College, great college in Boston, they issued a bond. They were trying to raise money. Corporations issue bonds. Starbucks has issued bonds. GM has issued bonds. Our government obviously issues a lot of different types of bonds. You might have heard of them referred to as bills or notes or bonds. Those are all under the bond family. Sometimes the terms are, the language is interchangeable. It really is related to how long when is the bond going to be repaid. So bills and notes have shorter maturities than, so I can't remember the exact guidelines, but it's like under 10 years, you might call them bills or notes. And then after that, you would call them bonds. And then also even municipalities, right? Towns issue bonds if they're trying to build a bridge or a football stadium or something like that, or even a school renovation. They're all different issuers out there asking for money. They're all different entities lending the money. So if you're that entity lending the money to the issuer, it really helps to understand what's going on, what a bond is, and how also it's different from stocks. So two different ways to invest. Stocks are your relationship. If a company is trying to raise money, they issue stock. If an entity is trying to raise money, they might issue a bond. In both cases, you're giving money. But in one instance, you're the owner, right? A stock relationship is you're participating in ownership of the company. And a bond relationship is you're the lender. Now, bonds are much, much, much more clearly defined, right? So when you buy a stock, you could own it for a day. You could own it for the rest of your life, right? It's very open-ended. So the term is very open-ended. Bonds are different. When you buy a bond, it comes with a very specific, it's very defined, right? So there'll be a bond that's issued and it's going to be, you're going to get your principal back, whatever you lend, you're going to get it back after, it'll be 2 years or 5 years or 10 years. It's very specific at the start of the bond. It's very well defined. And then the coupon, which is the interest that the bond pays, that's very well defined in almost all circumstances. Of course, there are always exceptions. There are variable rate bonds and things like that that are linked to some kind of benchmark. But, let's just say, what you're going to find about stocks versus bonds is that when you give your money into some, when you're purchasing a bond, it's very, very well defined versus stocks where it's like, who knows what's going to happen. And then the outcome is supposed to be very well defined. If nothing goes wrong, if there's not a major default, if the bond issuer can pay back the principal, then the whole relationship is very predictable, right? Whereas with a stock, kind of anything could happen with the value of the company and things like that. Okay, and then meanwhile, there are stocks that pay dividends, and there are plenty of people that look for income using stocks by looking at dividends. And so they have sort of similar goals with why they would buy a stock versus a bond because they want the income. So there are stocks that pay dividends, but not all. And when a bond pays you a specific periodic amount, that interest is actually, that's their coupon, right? So at the outset of buying a bond, they'll give you a term, like this is a 5-year bond or a 7-year bond or a 10-year bond, and it'll promise a certain amount of interest, and that amount is the coupon, which is not actually the same as the yield. So what ends up happening is when a bond is originally issued at a certain price, the face value of like $1,000, and it has a coupon, say of 5%, well, then once the bond is issued and now it's traded later on in a secondary market, its price can fluctuate. So that's why, the coupon is always set. It's a periodic payment. It's always the same and it's always set. But the yield can change because the underlying price of the bond is changing. So yield and coupon are not the same thing, but the coupon is at the outset what the interest on the bond is going to be. Okay, so what is this business of interest rate risk? And hopefully this is going to be very easy for you to understand. So prior to 2022, we had a very, very, very long period of interest rates in this country either falling or going sideways, right? And when that's happening, then bond prices are rising. So people who are participating in purchasing bonds, were very happy, right? Because things were going well. So like, why would that be? What's so great about interest rates falling if you're participating in bond ownership? So I tried to make this pretty easy. So Starbucks actually does issue bonds. I didn't check to find out what their coupon rate was, but you can imagine there's a Starbucks on like, every 10 corners, it seems. So Starbucks issues a bond. And now when they issue a bond, they issue like an enormous, they try to sell like $500 million worth of bonds, right? They're trying to raise a lot of money. But that bond issue gets purchased by different entities, and then it gets broken up into little pieces where your brokerage will be able to sell you just $1,000 at a time. So if you wanted to participate in this bond issuance and your brokerage is has access to this bond, then in your own brokerage account you can just go on and actually purchase the bond directly in your brokerage account, and you can see what is the bond offering. So let's just imagine someone does that, $1,000 for the Starbucks bond, it's paying 5%. Okay, well, a year or two passes. It's paying 5% every year for 10 years. A year or two passes, interest rates are falling. So now, the next time Starbucks goes to issue a bond, or any other corporation, if the prevailing rates are 3% for a 10-year, well, that's not good for the people who are buying at that time, but it's really good for the people who already own bonds that are paying 5%. So you can imagine the people who have bonds that are paying 5%, the value, right? If you added up all those coupon payments, because it's 5% for, every year, it's a 5% rate for 10 years. So that's a $500 value. Now, coupons, by the way, like they usually almost all the ones I've ever seen are paying semi-annually, right? So you look in your brokerage statement and like every 6 months you're getting that. Well, if it's 5%, you're getting 2.5% and then another 2.5%. So every 6 months you're getting that to add it up to the 5%. So over the lifetime of you owning that bond, you will have gotten $500. Well, the new people trying to do the same thing, they can only buy a 3% bond. Well, the lifetime value of that is $300 worth of coupon payments. So over a 10-year period, they're only getting $300. But what you have over a 10-year period is yielding $500. So if you just look at those cash flows, you see that they're different. You see that your deal is better, right? And you've both paid $1,000. Well, how can these two bonds exist in a secondary market, right? So bonds are issued, that's the primary market, then they live on and they get traded every day, and that's the secondary market. Well, who is going to buy the 3% bond if there are these 5% bonds out there floating around? Well, a lot of people will, because what will happen is the 5% bond will actually trade at a premium, right? So that's what they mean when the bond price will go up. So if I want to buy, if all I can access are these 3% bonds, if I offer $1,000, then what's going to happen is, and I did not do the actual bond math because it's pretty confusing. It's not this straight like $200 difference, so you're going to pay $200 more for the 5% bond. I mean, there's a $200 difference between the $500 in coupon payments and the $300 in coupon payments. but that's not how it works because those payments are periodic and it's the future value of those payments, discounted cash flows and all these things that, the math gets a little crazy. So it's not like you would pay $1,200 for that bond to make up for the coupon difference, but you're going to pay more than $1,000. Say you're going to have to pay $1,100 or whatever. So that's how people used to make money in bonds. And when they say bond prices are rising, you would make money in bonds not just on the coupon payment, but the bond you purchased, the actual value of it, the price somebody would pay for it goes up when interest rates are falling. So that was the good old days. And the good old days lasted a very, very long time. Super unusual. So there was a 40-year trend of declining interest rates. So if you look at this chart, you go all the way back to 1982. I mean, it's amazing how high interest rates used to be. It's super remarkable, especially when you consider our recency bias and how we really think of prior to the pandemic and things like that. I mean, we just got so accustomed to super, super low interest rates. I mean, there are people today that are just astounded that they might have to pay for a 7% mortgage. That seems unheard of. And meanwhile, back in the day, people were thrilled if they could have an 8% mortgage in the 90s. That was fantastic, unheard of. So interest rates were super high. And then over the course of literally 40 years, they just started to drift down, drift down, drift down. But they would either go down or sideways mostly. So people holding bonds really got lulled into the sense that bonds were safe because the interest rates were always behaving in a way that would make you think that bonds were safe, because the bond you were holding was going to probably go up in value because interest rates were going down. So someone's going to pay you for the bond that you have more than what you paid, so that your bond price is going to go up. That was a 40-year trend. Okay, so investors have spent a lifetime enjoying declining or sideways interest rates. So that's the universe where bond prices rise, okay? Then, I'm sure I don't have to remind you guys, inflation went crazy, right? At one point, it peaked at 9.1%. It's caused a total panic. The Fed hiked interest rates a total of 11 times starting in March of 2022. And all of a sudden, these really, really low interest rates just evaporated, right? And it was such a shock to the system. So that's why 2022 was such a disaster for bonds, because there wasn't a slight rise in interest rates. I mean, this sort of drift down did not turn into a drift up. It went into a sharp turn, a super sharp turn. And that has been really, really tough for bonds. It was super tough in 2022. So let's look at that. Why is that so bad? So let's get back to our Starbucks, right? So when bond prices fall, bond prices fall when interest rates rise. Well, why would that be? Okay, so now we've got the opposite thing going on, right? So say you have a bond from Starbucks and it's paying a 3% coupon, right? So the lifetime, if you add up all those coupon payments, that's $300. But now interest rates are, going up dramatically, and the new bonds are paying 5%. And 5% over a 10-year period is $500, right? So you're holding an asset that over 10 years is going to yield $300, and then you get your principal back. But anyone can go out and spend the same amount and get $500 over a 10-year period. So what you're holding on to is not as valuable. So the underlying bond price has to drop to make up for the fact that people, if they spend $1,000, they can get the 5% coupon for 10 years. So the only way to sell your bond, if you're going to hold your bond to maturity, that's fine. Then technically you haven't lost money, other than sort of the opportunity cost of not owning the other bond. But if you want to sell your bond before it matures, you have to take a lower price. That's the only way to adjust this differential of what the coupon payments are going to pay out. So this is what happened across the board, right? And you can imagine that a lot of these bonds that were really long term, if they were only paying 2%, 2.5%, 3%, and they were for really, really long terms, like 20 and 30 years. Well, if new bonds come out and they're paying 4%, 5% for that super, super long maturity, then the other bonds are really in trouble. I mean, it's a little tricky because who knows where interest rates are going, right? But there are bonds being issued that are offering 4%, 5% for a 20-year period, and somebody is sitting on that same bond paying 2% for a 20-year period, they're really in trouble. If they're trying to sell, if they're trying to, get rid of the bonds they're holding on to in a secondary market, their bond has a much, much lower value. So this is what happens. And so this is what happened in 2022. And, when I was reading The Motley Fool, it was pretty incredible to realize, that if people had wanted at that point in 2022 to sell their long-term bonds on the secondary market, I mean, the price, I mean, to lose 39% on a bond is just so shocking when there's no credit quality problem. It's not that the bond itself, that the issuer is somehow suspect. It's just that the interest rate environment has completely changed. So the Motley Fool was saying that a 30-year treasury, right? So if you had a 30-year treasury and maybe it was paying 2 or 3%, and now people can make 4.5%, 5%, just you get destroyed if it's a 30-year bond. So this is just one way to say that the effect is much worse the longer the term, right? And that kind of makes sense. Now, you will hear people say, the bond has a duration of 30 years or whatever. They're actually using that word incorrectly, but people do it all the time. They use it interchangeably with like maturity and term and things like that. But duration is really actually very mathematical, and it's interest rate sensitivity. So it's a measure of like, if you own a bond and interest rates go up, it can tell you like how sensitive you are to the rise in interest rates. And that really has to do with how long you're supposed to hold the bond, the term of the bond. So I'm kind of getting into the weeds here, but really you can kind of understand as bonds are, rates are going up, how bad it could be if you have a very long-term bond, right? And rates are going up because what you're holding on to doesn't have as much value and you're locked in for years and years and years. Okay, so, because of this, because bonds are so sensitive to interest rates, people get really obsessed with interest rate forecasts. What is the Fed going to do? Where is this all going? And the thing is, I mean, these aren't my words. This guy, John Spooner, has been a financial advisor, written a bunch of books. And he's like, at the end of the day, I mean, he's been doing this for years. He's like, no one knows the direction of interest rates, right? I mean, people feel like they do. They feel like they understand what the Fed is going to have to do. But, and maybe they'll get it right for like the next 6 months or a year. But if you're going to buy a bond that's a 5-year bond, like you just have no idea what's happening 3 years from now, 5 years from now, right? So one piece of advice is don't waste time on the forecasts. Don't waste time obsessing. And just beware of the longer term bonds, right? Because that's really where the movement in interest rates is, that's the interest rate risk, is anything that has the longer term. And if you have a financial advisor, they should understand all the bond math. They should be able to give you an actual number. Like if I buy a 10-year bond and interest rates go up 1%, what does that mean for me in terms of a loss if I want to sell it? Now, you don't have to sell, right? So you can, if you buy a high quality bond and there's nothing wrong with the issuer, then you're not losing anything. You just hold that bond to maturity, you collect all your coupon payments. All you've lost is the opportunity cost of, too bad you didn't buy the bond a little bit later that had the higher interest rate. But you're not necessarily losing any money if you're not selling it in the secondary market before it matures. But you just, in general, you want to be aware of these longer term bonds. Okay, and again, if you have any questions, you can just go ahead and put them in the chat. I don't see any questions right now, but and I don't want to go too quickly, but always happy to stop for the questions. Okay, so credit worthiness risk. So just like you, bonds have a credit score. So hopefully everybody here is aware of like how their personal credit score works. They're the three companies, TransUnion, Equifax, Experian. They're all out there gathering all this information on your behavior, your car loan, your credit cards, your store cards, your student loans. Anytime you've borrowed money or been, credit has been extended to you, that relationship is being tracked. It's amazing to me. If you've ever really scanned a credit report, it's like, wow, they really watched me every month of my life for years to see what I was doing. And if you miss a payment, boy, ding, it's like right on that credit report. And that contributes to your credit score. Are you paying your bills on time? Are you a good bet? Are you always paying, are you paying in a timely manner? How much of your credit are you using? And that's coming up with your credit score. Well, bonds also have a credit score, right? It's not the same, obviously, as how yours is constructed, but you have these three main companies. So Moody's, Standard & Poor, and Fitch are these bond rating agencies, and they have legions of analysts that are scouring the bond universe and figuring out, of the issuers of these bonds, based on a lot of different criteria. There could just be the macro criteria. Like a company could be extremely well run and extremely creditworthy, but maybe it's an insurance company that had a lot of exposure to California, and now there have been all these California fires. Like that would lower the creditworthiness of that company if they turned around and tried to issue a bond after all these fires occurred. Like no fault from the company, but those are things that happened, right? So you have this army of analysts at these different companies looking over all the entities. I don't want to just say companies, right? And when you're talking about stocks, obviously you're talking about companies. The bond universe is much, much bigger than the stock universe because there are so many more entities that could be participating, right? Like a town, a municipality, doesn't issue stock, right? You can't have partial ownership of a town. But a town, a municipality can issue a bond. A college can issue a bond. All the different corporations can issue bonds, right? Governments, various governments issue bonds. So that universe is just really, really big. And if to play in that space, right, you have to, these entities open themselves up to be evaluated. And these companies, and depending on the bond, it's not like it's necessarily been evaluated by all these different companies, right? I mean, that doesn't happen. But if you want something investment grade, it's like at least one of the three is going to give you some kind of a score on this bond. So a lot of people get confused because these bond ratings look pretty good, right? Like if your kid's in school and comes home with a B, that doesn't sound too bad, right? But you have to be really careful because bond ratings, once you start seeing a B, that's a moderate risk, right? So only stuff in the A's is really good. So if you want to be super safe, you never want to see a B. People invest in bonds that have some kind of a B rating, whether it's BAA or BA or BB, they do that all the time. And I'm going to show you, actually, I think I have it right here. This is kind of interesting. So the state of Wisconsin, right? So their pension fund and all the money that state has, that has to be invested. And they go into all different kinds of bonds. And they share that information, which is really nice that they share it with everybody. And they're in all different kinds of investment grade bonds, or they're even in non-investment grade bonds. They're in junk bonds, right? But it's nice that they'll show people that that more than half of their bonds are in the A-rated, right? And they're more than half because they want to be really careful about credit quality. But they get down into these triple B or BA or BB. And as they're putting it in order of creditworthiness. And I think a lot of people get stuck if they see that a bond has a BB rating. they think that's pretty good, but look how many rungs down it actually is. That's not a great rating, especially if your goal is to be super safe. You have to be really careful and learn how these bond ratings are constructed and what is the top. So the one thing I would say is it's nothing like reading your kid's report card, right? A B is not good. It's, A's are good. B, you're starting getting into some murky territory, and C's are really bad, really bad. Doesn't mean you're going to avoid them, but they're really bad, and they're not investment grade. So this is what is. So let me go back to this. Okay, so when you hear high yield bond, right? Like that sounds like a very, very appealing title, high yield. Who doesn't want high yield? It's what you want in your savings account, right? I want a high yield bond. But high yield is a euphemism in the bond world for a junk bond. And a junk bond just basically means the issuer is not investment grade, that the analysts have determined, there's some real risk of default, right? Default does not mean you will never get your money back. Default just means that this bond issuer that has made certain promises, right? Here's the term, lend me the money. I'll give you the entire amount back in 5 years, and semi-annually, I will give you this coupon payment, right? So a default is any part of that falling apart, right? If some issuer hits hard times and can't make the coupon payment, can't make the interest payment, or the principal needs to be returned, but they can only return 85 cents on every dollar. That all is default, right? Default doesn't mean it went to zero, you get nothing, but it just means that, whatever was agreed upon is not happening. So that's where you have to really understand these bond ratings. And there is at the library this S&P. So I think you can see it from the databases. There are all these databases at the library. If you go into the library and you just go to one of their computers, you can access the S&P NetAdvantage database, and you can look up any company and look up their bond rating. And a librarian can help you do this. So I think it's an amazing service that the library has. Siobhan, I'm not sure that you can do that from home. Do you know?
So, so S&P is the only business database that they only allow use in the library. So that particular one you would have to be in the building for. Most of
Yeah.
our other databases you can use from home with your library card.
So I think it's because it's really expensive too, right?
Yeah, and they're very, protective of the information within the database, so that's how they kind of keep a handle on it.
It's kind of, I'm just going to check the chat, but it's kind of amazing that you guys offer that. Um, is this a link that you sent?
That's a link to the library databases, and the business ones are listed first. So,
Great. I mean, you guys have just such amazing resources, but anyone who's looking to buy bonds directly, especially, it's worth an afternoon at the library to just go in with your list and look up the bond ratings. It's just fantastic that you guys do that. Okay, so hopefully this is making sense, and you want to be really careful about creditworthiness and these different bond ratings. Okay, so we did our interest rate risk, we did our creditworthiness risk. Let me actually say one more thing though about the creditworthiness. I'm actually going to go down. I want to go down to, oops, that's not what I wanted to do. You cannot trust anybody else on creditworthiness. Okay, so this is a typical and a true 401k menu, right? There's a typical, this is what they look like. Someone, gets their new job and it's like, okay, well, what funds do you want to go into for your 401k? And you look at this and it's like, okay, well, here are the conservative investments, meaning you would think that by conservative, they're safer. And then on the right-hand side, aggressive, oh, those are less safe. Okay. Well, I'm looking at this, and under bonds, it has the Invesco High Yield Fund under conservative. And that doesn't
and
make
that
any
doesn't make any
sense.
sense.
Right.
Right.
And then,
And
There's like an echo. I don't know why that happened. Um, so you cannot trust the literature, right? If somebody hands you a menu and says, oh, these are the offerings and this is what's safe and this is what isn't safe, you really have to drill down and do your own research. And just the words high yield should have been like a red flag. But whoever put this together, I mean, the junk bond universe is not conservative. It doesn't mean you shouldn't invest in it. I mean, a lot of people are interested in less than investment grade bonds because they have higher yields and they trust certain companies like an Invesco and they trust certain managers. It's like they're going to figure out, what are the companies to buy? They're just going to figure it out and they're going to, and if you buy enough companies, then there's a hope that if like one of them defaults, 1 out of 10 or 1 out of 20 or whatever, that, you'll, because the yields are higher, even if 1 or 2 companies ends up being problematic, that the overall higher yields are still a better bet than going with lower, safer yields. These are the decisions that people make. I'm not against it, but you have to know what you're doing. And you cannot trust the literature. All right. So let me see. That was pretty. I put that at the bottom to see if we were going to have time for that. Okay.
I
Right.
can ask one question if you don't
Yeah,
mind.
sure.
So, because you went through some of this kind of quickly, it's all excellent information. If you're looking, you just mentioned Invesco, was it? Is that who
Yeah,
you just? Yeah, so because I see them advertising a lot, like that QQQ
right,
series.
right.
So how do you know like one series from another, whether it's a good bond or not? I mean, do
So,
you look up the S&P rating on it and you just
so
go
if
by
you're
that?
right, if you're buying an individual bond, that's
Right,
easy, right? The
right,
individual bond will have one of these ratings. Now, if you're going through a company like PIMCO or Invesco or Vanguard or Fidelity, they all have bond funds, right?
right.
And then you get like the ticker symbol for the bond fund, and you literally research that particular fund. Like, and they'll usually say is, you look it up on the company's website and it will say like who manages the fund. It will say what has the return been of the fund. It will say what are the holdings inside the fund. It'll usually say like the top 10 holdings. And, so you can really drill down and find out what's going on inside that fund. And then there are
Mhm.
also separate, like Morningstar. I don't know if you've ever, actually, I think the
Yeah.
library also has a Morningstar database subscription, right?
Yes, we do.
So like Morningstar does actually rates all the funds. So, I mean, a little bit, some of that is like backward looking, right? So they're basing their ratings on previous returns, but that is some level of comfort, right? If like a third party is saying that that's a 4-star fund versus a 5-star fund. But you can really find out a lot about an individual fund. You just have to take the time. And what's weird here, I got to go back to that menu because I thought it was really weird that they didn't give the ticker symbols, right? So obviously, like if there's a stock, people understand like a stock has a ticker symbol, but they don't
Right.
necessarily understand that any mutual fund, any ETF, really, all of these have ticker symbols. And I think they should have put them here. They shouldn't make you have to go look it up and go guess, right? But you could research the Invesco High Yield Fund, and then you could find its ticker symbol. Now, what I found weird about this, I remember doing it a while ago, is like it was kind of like 3 or 4 different ticker symbols you'd have to kind of choose from, but they all had very, very similar holdings. So I wasn't sure kind of why they were ever
Well,
differentiated.
where do you look for these ticker symbols?
Um, Well, I just Google, I was like Googling Invesco high yield fund, but
Right.
you could do it the other way where you start at Morningstar. If you start at Morningstar and just look at what, their best rated bond funds, then they will
Right.
absolutely say like, oh, well, they really like the PIMCO intermediate term bond fund, and they'll give you the ticker symbol right there. A
Okay.
lot of like Kiplinger's Personal Finance magazine, a lot of there's a lot of financial journalism out there that will recommend different funds. So that is at least some place to start.
So you don't have to talk to Kramer.
Oh, Kramer. Oh,
If you could only. But he doesn't do funds. He only does individual offerings, whether
yeah,
it's
and he
bonds.
hardly ever does bonds. He's very entertaining. I like him. He's funny, but I would not use him for investment advice. I don't even, he's very knowledgeable, but he did this whole thing about like, the stocks that pay the best dividends. And he named like totally worthy companies. And I tracked them for a while, and like Newell Brands was one of them. Newell Brands owns a lot of like the consumer products, and Newell Brands went down more than 50%. So who cares if you're getting like a 6% dividend if the stock itself, gets cut in half? So
He
yeah,
doesn't follow things deeply. He'll give you like a surface
right.
impression. I don't think he drills down so much. And he's
Yeah.
off, he's popular for a week with something and then he's off to the next thing. So
Yeah,
anyway,
totally.
okay. And who do you write for now? Or do you just write your book?
Yeah, I mean, I do these webinars. I'm asked to speak different places, but then I pretty much just write the books.
Okay.
Yeah. And
Thank
the
you.
library has, Siobhan, I think you guys, so my book that's Investing, Your Lively Jargon-Free Guide. Here, I'll show you the cover. I think you guys have, I think the library has 2 or 3 copies of it. Let me see. It's this, so what's great about this one, and Siobhan, the library has like 2 or 3 copies, right?
Yeah,
Yeah. So if
we
you
have
like,
we have both of
I
your books.
really, oh, go ahead. Sorry.
No, just say we have both of your books in the collection.
Oh, great. So in this book, if you're really interested in bonds, I feel like a lot of books, first of all, they're not lively, they're not jargon free, and they don't hold your hand. So in this book, I'm like, I'm going to give you examples of actual bonds, right? Like this was the bond that Apple issued. This is the bond that Starbucks issued. And exactly like, you learn how that there's a CUSIP number and like that's how a bond is identified. And this is the coupon. And this is what it means for a bond to lose value. And this is what it means for a bond to increase value. So there's a gal in town who sold bonds for Wells Fargo, and she reviewed my book just to make sure that it was all accurate. And she's like, "Ah, this is so easy to read." Finally, thank you. Like, don't, so if you're at all confused, then just go to the library, take out this book. It'll take you like half an hour to read the section, and you will totally, you'll be like a bond genius after that. And it will just feel so easy. Okay.
And are you doing one for stocks?
So this book, it starts with stocks. It does stocks and bonds. And yeah, it's meant to be, you know what they don't have enough of out there, because whether it's Bloomberg or the Wall Street Journal or Forbes, they write at a level that assumes that you were exposed to this and educated. It's almost like there's no middle school. Like, I wouldn't say that this is elementary school level. It's not that easy, but there's like no middle school. Like, just let's just get you the middle school understanding or the 10th grade understanding. And then all these other entities write as though you learn the stuff and they're just sort of writing at this college or post-college level. I'm like, no, where would you have learned it unless somebody taught it to you in your house? So yeah, that's what I try to do. Okay.
Kristen, you have a question in the chat too,
Okay, let me go back.
or maybe a comment.
Let's see. If you have an account with Schwab, Fidelity, or Vanguard, that's right. If you have an account with Schwab, Fidelity, or Vanguard, you can research the ratings on ETF, bond, etc. too. I forgot about that. Right, your own brokerage is probably sharing information with you, and it's not necessarily their rating. I mean, a lot of these guys, they use these third-party services and then use those ratings. Do you offer real estate investment education? Oh, it's almost like I paid you to ask me that. So that's my 3rd book. My next book is all about that. But we've had, which it's not ready yet. It's going to take a while. But we have had videos, 2 different videos on investing in real estate. And I think they were really helpful, really good. So again, on the the library's YouTube channel. You can look it up, and I think we just called it Investing in Real Estate. So hopefully that's a way to start until the book is done. Okay, so let's go back. Okay. All right, so we did creditworthiness risk. Oh, wait, was there one more in the chat? Hold on. Okay, perfect. Let's see. All right, so what we've got here is, okay, so what do I mean by fund risk? Okay, so maybe you've already experienced this with mutual funds in general, but the whole point of a mutual fund is that like your money is pooled with other people's money. And the good part of that is that you can have, for very little money, access to a diversified portfolio of bonds, which is great. Or, any mutual fund that's a diversified portfolio of something, sometimes you're doing stocks or stocks that have certain themes or whatever. But the good news is like you put in less money, but you get all this diversity, which is great. But sometimes that can backfire, right? Because in terms of behavioral finance, you can't control the behavior of other people if they're going to panic, right? So what happened in 2022 when bond prices started to just crater is that people in bond funds, when they saw their losses, they panicked. And then they demand from the manager of the fund to have their money back. And that puts the manager of the fund in a very bad position because the manager of the fund understands, that like if he can just hold these bonds to maturity, there's no loss. But if he has to give certain people in the fund their money back, then he has to sell and take the loss in order to return the money. So he has to, what I'm basically saying is he has to react to the outflows, right? So manager sells for loss due to fund outflows, right? And you're stuck, right? Because you couldn't control the behavior of the other people in the fund. This really only matters around times of panic. And 2022 was a huge panic, but that really compounded the hysteria and the losses. And so if you own bonds directly and they're losing value, you can ride it out, right? You don't really know at the time when bonds are down what's going to happen next, because if bonds are down because interest rates are rising, well, 2 or 3 years from now, interest rates could be going down and everything, all the drama could be reversed and you could end up being totally fine. So you just don't know. That's the unknown. But if you're in one of these funds and other people are panicking, then you get whacked, right? Then the loss is real. So that's just the problem with fund risk. Does it mean you should never be in a bond fund? No. But again, this is especially if the panic is around the longer the term of the bond, the worse the effect when interest rates rise, there's more of a chance of a panic. So again, it just really gets back to trying to understand. I think the shorter duration bonds are the way to go, just to be on the safe side, especially if you're in a bond fund where it might just cause other people to panic. The losses might cause other people to panic. Let me just look at the chat. This might still be part of the same thing. Oh, okay. Thanks, Siobhan. That's the recording is how to invest in real estate. Yeah.
I
And it's
think there
also,
was a question above my link too, though.
oh, there's a question about it. Let's see.
Above that.
What are the best type of bonds in a diversified retirement portfolio? Okay, so you have to figure out like your comfort zone with risk. I mean, I could definitely, and also how much money do you have? So how diversified can you be? Like people who have a lot of money and they can do a really sophisticated bond ladder, then I think they can do some, they can throw in bonds, individual bonds that have like the B ratings. I don't think that's too scary. So I think it depends on how much money you have and what your risk tolerance is. But if you want to just be super safe, I mean, treasuries are great. US treasuries are fantastic. So, and at the end, I'm going to talk about some specific things like I bonds and tips and things. So maybe that'll also answer your question. Okay. Let's see. All right, where are we with this? We are Okay, so this is again just, you know, a writer from Forbes sort of reiterating everything I'm saying about the fund flows and, you know, how you might just get slammed, but if you own bonds in, you know, directly and individually, then you don't have to worry about that. Okay, now call risk. Some people have never even heard of call risk, and it's a feature of bonds. So I always like to quote David Swensen. David Swensen was famous for running the Yale Endowment and just bringing it to like such heights and really transforming, I mean, just transforming endowment investing in general. I mean, just he's quoted all the time. He's studied, his work has been studied all the time. The people who run like Harvard Endowment, all these big endowments, I mean, it's like you're sort of required to learn everything David Swensen had to teach. And he really, really hated call risk because he would say that it's like, you know, it's the heads I win, tails you lose situation where what can happen, again, because interest rates move around, is that a corporation will issue a bond and they'll offer a coupon. So say some corporation issue, say it's McDonald's, right? I don't know what if this ever happened. They offer a bond at 6%, and then interest rates go down. Well, they have a call provision, which means they can just give you your money back on the bond. So you buy the bond, it's supposed to be a 5-year term at 6%. But if interest rates really go down, then McDonald's is like, oh, we have a call provision. So we're going to give you your money back early. You don't want your money back. That's why you bought the bond. You wanted to make 6% each year for 5 years. But now McDonald's is looking around and going like, oh, well, we don't actually have to pay that because now interest rates are down. So we're going to give you your money back early. So that's what it means to call the bond. So whatever term that was locked in, they're not locked in. And you don't want this. You don't want your money back. But that's what call risk is. So it really bothered David Swensen that these bonds like could do that because they're like, okay, so the person who buys the bond, they don't have the call. You know, they're going to get stuck in the secondary market having to sell their bond at a discount when interest rates go down. So they can't get their full principal back. It's not like they can call McDonald's and be like, hey, well, okay, so no, in that case, I'm sorry. In that case, like, so the McDonald's bond's at 6%, then interest rates go up, right? The person on the other end can't go to McDonald's and be like, hey, either you have to start giving me a higher interest rate or give me my principal back. They can't do that. And the secondary market, the bond would be discounted. So it's very one-sided and it just benefits the corporations. So this is a problem with corporate bonds you should just know about. Nothing you can do about it, but it's troublesome, right? So it's almost like you can think you have smooth sailing because you've carefully selected your bonds. And then if interest rates go down significantly, the bond might get called. And then you're back to looking for yield. Okay, are we ready for some good news? I mean, I've definitely told you all the bad stuff, but let's talk about some good things. I mean, there's so many really wonderful qualities of bonds out there. Like I really love I bonds, and you can purchase them directly through Treasury Direct, and you don't need a lot of money, right? I think it's only $25. It might be like $100 to start, and then $25 increments and things like that. But you know, they're totally safe. This is through the government, totally safe. They have a good yield. And it's a yield that changes, but it's interest rate, not interest rate, it's inflation sensitive, right? So you'll always be a little bit ahead of inflation, which is good. But then there are just qualities that certain assets have, you know, not even just bonds, but if you just understand the asset universe, you might find out something that's like, wow, that works for me. That's something that I need that I didn't even know. So when you purchase I bonds, the people who hold I bonds, if they're clever and they know, but like either they're in a relatively low income or they know they're going to have a lower income later when their kid goes to school, they buy the I bonds. The interest is accruing, right? They never actually have to take the interest money. So it accrues tax-free, which is fantastic. But when they finally go to cash in the bond, they don't have to pay tax on the interest as long as that amount of money is used toward qualified education expenses. So it's really like a college savings plan. And you have to be checking what the income limits are. And I don't remember them off the top of my head, but it's such an interesting thing to do, to like have a bond that's earning money. You're not paying tax on the money. It accrues tax-free. But when you go to cash it in, if you use it for education, then you never pay tax. I mean, these are just some really cool things that the bond is completely safe. It's got a good yield. You could use it for education. So for the right person, it could be like perfect, right? Then municipal bonds, if you're in a very, very high tax bracket, even though the yield on the municipal bond might not seem competitive relative to other bonds, you pay no tax on, well, no federal tax, and probably no state tax if you purchase the municipal bond in the state where if you live in the state of the bond issuer, of the municipality that issued the bond, then you probably don't pay the state either. But again, these are just features of bonds that, if the bond is safe and the yield is good and you're in a super high tax bracket and you're going to get slammed on the interest on the bond, then, all of a sudden here's some savings vehicle that's going to be better for you than a CD or a savings account or other things where, because of the tax consequences, it's just better for you to own the municipal bond, and the municipal bond is safe. And then, shorter term treasuries. And by the way, when I was writing my book, I had this really, really, really good person who was proofreading it, and she looked it up. And apparently the way you spell treasuries is this way with the YS, which really bugs me. But so I put it in there. It's almost like I want to spell it the other way because this looks wrong, but she swears that this is my proofreader. She swears this is the right way. But like, again, shorter term treasuries, they're super, super safe. They have decent yields. You can't get in that much trouble, even if interest rates go up, especially you just hold to maturity, you're fine. So there's so many good things about bonds where they should be the safe ballast of the ship, which is the reason why people purchase them. So when you have like safe and you have yields that are beating inflation and you have bonds that are not volatile, then, those are like that's how bonds ought to be used, in my humble opinion. Okay, so, and let's get, the PIMCOs of the world. So PIMCO is like a humongous bond company. Even they're saying, that it was not good times for them when yields were super, super low. And even they're saying now that like, it's just kind of gotten more interesting because of the higher interest rates. Then people can start looking at bonds and locking in 5%, coupon rates. And it's like, who knows where interest rates are going? So you won't know, if you lock into something that's like 5% for 5 years, well, 3 years from now, interest rates might be 3%, and you might feel fantastic. You might feel super smart. So nobody knows the direction of interest rates. You can't get in too much trouble as long as you don't go for the longer terms, right? Like the 10 years and the 20 years and the 30 years. I'm just going to check the chat again because I did see something pop up. Did you mention managed bond ETFs versus passive bond in ETFs? I did not, but I'm happy to mention them. Actually, there's one thing that's really kind of cool now. I don't know if you've noticed this about ETFs in general, but it used to be you could not get into, like, if you think about like the really, really good managers, you used to not even be able to get into certain bond funds unless a registered investment advisor got you in, or a certain financial advisor got you in. You needed like this kind of private intermediary. So this came up with Dimensional Funds. Like Dimensional Funds is a company that the founder of it went to University of Chicago. He was a super smart guy, and his company just like has done so well for these clients. And it used to be you could only get into a dimensional fund through an advisor. Well, then because of ETFs, all of a sudden dimensional funds has an ETF. I'm trying to, let me see if I have their bond ETF on my phone. But I was like, this is fantastic. Now anybody can just bypass the whole advisor channel and get into a dimensional fund ETF. And again, that would be managed. So I think what you're saying is like, just, even if it's like a Schwab fund or a Vanguard fund or something where you don't need the advisor channel. Okay, yes, this is it. DFCF. DFCF is the Dimensional Core Fixed Income ETF. And I remember when this came out, I thought, how in the world am I, because I had purchased it, able to own a dimensional core fund when I don't have an advisor getting it for me? Like, this is so exciting. And it's really just because of ETFs now, because there's no way to have like a private ETF, right? It's either exchange traded or it's not. So to answer your question.
Guy?
Oh, sorry,
Kristen,
what?
who's the guy that you were just mentioning?
So I'm blanking on his name. I shouldn't. Booth. Is it Booth? What at University of Chicago?
Famous. Is he the guy from who they named the Booth School after?
Yes.
You're-
Yeah. Yes.
Oh, wow.
Yeah. So, I mean, he made so much money. He came back and offered U Chicago some outrageous sum. And they said, we're going to name the school after you. And he said, oh, you don't have to do that. He's like, but it's nice if you do. So wouldn't hurt. Yeah. Well, I can't remember his first name, but like, this is amazing that people can get into a dimensional fund. But it's true, like, I know these wealth managers at Alliance Bernstein, and Alliance Bernstein is a very reputable wealth management company, but you can only get in there if you have at least $1 million. And they were telling me about their ETFs, and I said, but again, guys, like, that means anybody can buy your ETFs. So I mean, they offer a lot more than just a specific financial product. I mean, they're going to sit down with you. They're going to get to know you, all your goals and your whole family. And, but at the end of the day, it's like the fact that you actually have access to these products is pretty amazing. So really, if there's any like company that you're really interested in, but you know that you needed a financial advisor, if they're doing ETFs, you can bypass the financial advisor and just do their ETFs. But to answer the question, like managed versus passive, a lot of people will tell you, you can't beat the market, right? That's kind of like a slogan. So you should always do passive investing. And that is not true with bonds. Okay. So the research shows that's absolutely true with stocks, over the long run, that the stock picking doesn't work. But with the bond funds, the bond fund picking actually does work. So management does matter. So managed versus passive is different. And again, this kind of gets back to like, you could look at the Morningstar ratings and things like that of like, who's doing a good job out there. Hopefully that answers your question. So one question is, what is considered shorter term? I'm not saying that this is what the industry says, but if you're looking for like sensitivity to interest rates, you want to go 5 years or less, right? That would be, because then you're much less sensitive to a big change in interest rates. If you're at the 10-year, 20-year, 30-year, you are really going to get crushed if interest rates go a lot higher. Yeah. Okay, so I think that was it. Let me just take a quick look. Yep, I just want to do one more thing. What you're going to hear a lot about, especially the people in the wealth world, they're not doing bonds anymore. That's, so passé. They're doing private credit, right? So private credit, very similar to bonds, but really most people just don't have access to it. So I was talking to my friends at Alliance Bernstein, they're the wealth managers, but it's like, if you want to get into private credit, you have to have like $1 million just to have an account with them. And then the lowest amount you could possibly do private credit for is $50,000. So you're going to hear a lot about how private credit is replacing bonds, but it's pretty far out, right? I mean, it's still like a huge outlay. Like I can go on and buy $1,000 worth of a bond tomorrow, on my Schwab account, but I'm not going to go do this. So anyway, that's one last thing I wanted to mention. And then I do think that is it, right? Oh, okay. Don't forget the next webinar, March 11th, all about the startups. And yeah, That's all I got. And if we have any more questions, you could put them in the chat. But those are your risks. I'm sorry, what? Oh, Siobhan, did you say something?
I did not. I think you're just getting feedback from someone that wasn't muted.
Oh, okay. All right. Well, that's all I got, folks. Hope it helped. Let's see. One question here. Oh, you're welcome. Thank you. Thank you
It
for
was
being.
very good, very good. Thank you.
Oh, thank you, Sally. Have a great night.
All right. Thank you, Kristen. Thank you, everyone, for joining us tonight.
Thanks, Siobhan. Have a great night.
All right. Have a great night, everyone. Take care.